Right. Good morning, Mr. Sonthalia. Cheryl also joining in the conversation. I wanted to get your view on the metal sector because that one also is one of the sectors which a lot of them are betting on, given the fact what is happening in China. The government is going ahead with their consumption boost, should bode well even for the metal counters globally as well. But what's your take? How should one actually read into the sector, because it's very heavily dependent on what happens across the globe?
As I alluded to in the beginning, that I am in the camp who believes that the US dollar is going to fall and going to fall something like 10 to 15% over the course of the next 12 months. And this is on account of whatever policy measures are getting taken out there. This will result in already the base metals doing quite well. The bullions, gold and silver is doing quite well. Other currencies like yen and euro likely to appreciate. So from all this point of view, whatever is pegged to the dollar, will tend to appreciate if the dollar depreciates. So from that point of view, all commodity stocks, including metal stocks, are likely to see a price inflation going forward. And mind you, China is giving us stimulus. You have the Eurozone talking about expansion of the fiscal deficit. So the growth mantle of the globe shifts away from the US to the Eurozone and China once again. And once the growth mantle shifts to China, of course, that's going to be positive from the demand point of view as well. So things are definitely improving at the margin as far as China is concerned, notwithstanding the trade tariff issues that loom large. But even with that, given that the big macro call is the dollar is supposed to depreciate, and if one believes that if manufacturing has to go back to the US, there is no way manufacturing can go back to the US if the US dollar remains very, very strong. So from that point of view also, I think US dollar has to depreciate for manufacturing to go back to the US. In all of this, commodities stand to gain.
Manish, up till now we are putting a brave face. Everyone is like, yeah, US has gone down, dollar will go down, India will benefit. But there would be a threshold beyond which it will start hurting the world. Whether it is leverage, whether it is mark-to-mark losses, whether it is hedge funds or whether it is ETFs. When such large concentrated trades in the world, when they reverse so sharply, the unknown effect of that is actually very brutal for financial markets. More than anything else, I'm actually worried about that.
See, I think everything has a place. So emerging market will have their place. You'll have the developed markets have their place. All of this deleveraging. So so the whole point is that whether the de-dollarization of the world, which has got started, is going to gather pace or not gather pace. I am of the belief that de-dollarization of the world and de-pegging of fiscal policies in emerging markets with a vis-a-vis the US dollar is likely to happen. There's nothing in the micro markets to understand. Everything has to be from a macro point of view. And the big call you have to take from a macro point of view. And that is also going to impact India per se. So given that, large cap, mid cap, small cap, we are not talking about when the valuations are extremely elevated. You're talking when the valuations have really corrected. Flows have been negative. You can jolly well play with the momentum on the downside. But having said that, I would believe that more than all the negatives are already priced in the stock prices as far as India is concerned. And if we keep a lid on the QIP issues and the preferential issues and the private equity exits, I think FI outflows and DI inflows would broadly match. That would again provide a floor to the stock prices as far as India is concerned.
If you like this video, then like, share and subscribe to ET Now.